what's going to happen to gold in 2023? Where's it going to go? Is it going to continue to climb that wall of worry it was doing in 2022? Well, we got several factors to help us look at it. One, I'm going to look at gold in relation to GDP, or gross domestic product. That is the overall output of an economy. And we'll see when that falls, it does affect the gold price. Hey everybody, this is Rob Keynes from GoldSilverPros.com. It is January 5th, 2023. It's a Thursday. And man, can you believe we're in the new year yet? I hope you guys had a great new year. I did. And I thought it'd be a good time to look at where gold is going in 2023. A lot happened in 2022. I think now, though, it's time to turn our page on that and look at 2023. And really what I want to know, is gold going to climb the wall of worry? Because there have been a lot of things that have happened in the economy, and with the Fed raising rates and geopolitical situations, which caused gold and silver both to do very well this year. They didn't sell off broadly like the rest of the markets did. When you look at the year-to-date figure, certainly they went up and down. But overall, gold and silver held serve. They did exactly what they're supposed to do in terms of increased market uncertainty, and they held their value. And while the rest of the markets capitulated and sold off. I mean, Bitcoin, the bond rates rose, stock market indexes all plummeted. Real estate started to turn over at the end of the year. Gold did well. So now what we want to do is see what's going to happen to gold in 2023. Where's it going to go? Is it going to continue to climb that wall of worry it was doing in 2022? Well, we got several factors to help us look at it. One, I'm going to look at gold in relation to GDP, or gross domestic product. That is the overall output of an economy. And we'll see when that falls, it does affect the gold price. The second thing we're going to look at is a technical analysis. We're going to look at Fibonacci's. I'm going to explain what those are. And I'm going to show you where I think the gold price could be going and why it went where it went to end up the year. All right, without further ado, let's go ahead and get started. And I'm just going to roll out a bunch of different charts, and we're going to roll through those charts and discuss what's going on. So here is a chart of gold basically dating back to the last crisis. Here's the Great Recession over here in 2008, 2009. All the way up to current day. So here's the new numbers. And what I've done is I've graphed out gold. As you can see right here, gold, I have a 50-day moving average, and I'll explain what that is here in a moment. I have a 200-day moving average, and I'll explain what that is here in a moment. And then I have the GDP. So the two main lines, the main black line here is gold. And then this green line right here is GDP. And we're going to show what happens to gold when GDP makes a move. And then I'm also going to talk about the 50 and 200-day moving averages and why those are significant. And actually, we're going to get into those at the very end. So save your curiosity about the 50 and 200-day moving average to the very end, and I'll tell you why those are important. All right. Now here, there's two distinct time periods. The last time we had a bull market in gold, and then this time. And I'm going to talk about why gold climbs the wall of worry. What is the wall of worry, you may ask? Well, that is where gold seems to climb from some previous price up to a much higher when it continues to do that over a couple of year period. And it's because people are worried about what's going on in the economy, geopolitically, politically, culturally, and from an energy perspective, commodity perspective, what the Fed is doing with interest rates. A lot of those things can affect gold. And when there's enough instability there, or uncertainty there is probably a better word, gold will be said to climb the wall of worry. And it's interesting to see how high it climbs and what it reacts to. In this particular case, I have singled out, for purposes of this illustration, GDP. I just want to know, using like the scientific method, everything else being held equal, how does GDP itself affect the gold price? Or more importantly, how does gold react to substantial changes in GDP that result from big events in the economy, whether financial, geopolitical, or whatever the case may be. All right, with that setup, let's look at the chart. On the left-hand side, we have something, I have a box here in purple called Gold Climbs the Wall of Worry. So this just outlines the time period between when gold really started to rise, when GDP was affecting it, or it was being affected by GDP, and when it stopped. So as you can see here, we had the Great Recession, 2008, we had GDP drop, and when GDP started dropping right here, we saw a gold price trade off a little bit. Is what happens. Gold will trade off, because this is the paper trade, not the physical. This is where spots determine. This is the futures market for gold, not physical trade. We're looking at the paper trade here. This is a chart of the paper trade on COMEX and what causes that gold spot price, okay? So don't think physical, think paper futures trading, the speculators, all those other guys. So it'll sell off as well. They'll sell the paper in the beginning. And then when it becomes clear how bad that event is, people may say, wait, we want to go back into gold. We want exposure to gold because gold is a safe haven. And so it immediately began this really long march. Now, GDP, receded, it looks like here, about a little over a year, maybe 4 or 5 months. And then it started to resume. But gold kept going. It kept going all the way to its 2011 high of around $1,900. And then after we had a healthy GDP and all the other things in the financial, markets began to stabilize because of what the Fed had done and how the economy is reacting, gold price started to fall. And it continued to fall until 2016, where it had a little bit of a head fake here, but GDP was still positive. And so it just, range traded for the most part between, I would say, 2013-ish, late 2013-ish to about mid, well, I'd say 2017. It went up a little bit. Really, 2018 is where it broke out. So that's where I put the second uh, um, section of the chart where we had a big event. We had the pandemic. And you can see here this very sharp drop in GDP as marked by the green line. I've got it circled in red here. And then gold started to rise and climb that wall of worry again. And because the drop in GDP was so sharp, the rise in gold, therefore, was so sharp. So there is not only a correlation between where the GDP goes and the gross domestic product of the nation and where people will get into gold. And when they fear that something is affecting the economy, they'll bid up the price of gold. That's why when GDP falls, gold price goes up. People put money into the safe haven asset, but also the strength of this is a little bit lazier GDP that happened over a period of time. And you had this really long climb in gold. It was pretty sharp, but it took some time, took a couple of years to get there. This one is a very sharp fall in GDP because we shut down the economy, GDP drops, and then it recovers. It's a V-shaped GDP recovery, but that caused gold to go nearly vertical to a new all-time high price of 2069 in some sense. And then, of course, as GDP recovers, gold just kind of, falls down. Then we have some events here in 2022, Russia, Ukraine, I'll get to that in a moment, which bid it back up. This is a geopolitical event, and then it fell again. So that's basically what happens. Gold climbs the wall of worry, and there's geopolitical events. Here's Russia, Ukraine. Gold climbs the wall of worry, falls back down. And then gold's coming back up, and we'll talk about that here in a moment. So that kind of sets the stage for where we are. And by the way, we're going to show you a chart here in a moment. This is the new GDP projection via the OECD. So let's talk about that. So the OECD Economic Outlook came out in September. These are the anticipated GDP growth rates to the end of the year this year, very positive, but you can see that they're falling. So they're calling for about 2 trillion worldwide less GDP, or 2 trillion less production across the world in 2023. This is their estimate. And so if that's the case, and we know when GDP falls, gold goes up, then we can expect to have higher gold prices. So this projection, if it comes true, where global GDP is falling, should cause gold to continue to rise. And we'll talk about where it may rise to here in a moment on the charts. So with this backdrop, we think slowing economy, maybe not a recession because you still have some growth rates in here, but GDP is starting to kind of turn down. The momentum is negative. Now it hasn't reached negative territory where we're actually not growing, but the momentum is negative. It's not accelerating, it's decelerating. That's the expected outlook from the OECD for next year. And I think that agrees with a lot of bank reports I've been reading, Goldman Sachs, Bank of America, and a lot of analyst reports, people that collect data and talk about economist reports. A lot of people think that the economy will slow down. A lot of people think we're actually going to hit a recession and we'll go to negative GDP in a lot of countries. So all these red lines could actually go on the left side of zero and go that way. And we could have negative, 2 and 3% or negative 1%. And if that's the case, when GDP goes negative, we have a sharp rise in gold. If GDP goes really negative, sharp rise in gold. And it depends on whether it's a gentle fall as to how that gold price rises or a sharp fall. Sharp falls where it's not fundamental and it's an engineered sort of stoppage due to the world health issue with the pandemic, tends, to have a nice recovery in GDP. Where we're working out past malinvestment and GDP needs to fall, and we need to have contraction in the markets, is where gold really rises for longer term because people are in it until they feel like everything's recovered. And you can see here, it rose until GDP was just about even. Once GDP recovers to where it was before is when gold starts losing its momentum and coming down. So there is seemingly a direct correlation, at least during the last two GDP downturns. Okay, there we go. So that is a macroeconomic indicator and how it affects gold. Now what I want to do is switch over to technical analysis, because in technical analysis, I want to see, okay, where is it going? Where are the traders going to put their stops? Okay, because all traders, when you're trading on a paper market, futures market, what you want to do is you want to see where you think everybody else is going to trade to. So for example, if you're trading paper and there's a big sell-off coming, you want to get out right before the sell-off so you can, get your money for your paper. You don't want to sell off into the sell-off because it's going to be going down. You're going to be losing money. So traders will graph out where they think the price could be going, and these are the points where they either buy or sell. Pretty simple. Well, we can also use this for technical analysis. Now, remember, technical analysis is always backward looking. We're not looking into the future, but we're looking at in the past. seeing where the price of something had changed, in this case, gold, and trying to figure out why, and then using that as a model for where it possibly could be going forward for some potential projections on our trading, or where we're going to hold our gold and silver at, or where we may buy our gold and silver at. Now, before we go any further, I wanted to mention that this is for educational research purposes only. I'm not your financial advisor and cannot give financial advice, and please do not trade on this information. Okay, with that being said, let's go into technical analysis. Here I have two indicators. I have the 250-day moving average, which we'll get to here in a moment, and then we have Fibonacci lines. Fibonacci is basically Fibonacci lines or sequences is a mathematical sequence that shows up in nature many, many times. It'll be reflected in the markets, and it'll be reflected in other places like population growth and things like that. And it was done by an Italian economist a long time ago who basically figured this relationship out. And then it was eventually named after him, the Fibonacci. There's two different Fibonacci's that I typically use. You've got lines and the arc, and I'll explain those in a moment. For the lines, I basically just wanted to know what the market was doing and why we have this rock bottom price. Why is it this rock bottom price? Because the price tested twice here recently and is now surging past. So I think we're past where gold could bottom to at 1625-ish. I don't think it's going back down. The momentum for what's going on in the market plus the technical indicators indicate that we're not going back down here to the bottom. So I've labeled this the rock bottom price. And if you notice, this is a 50% Fibonacci between the high at the end of 2020 and basically the range traded lows back to 2016. So in other words, this is the base that traders are looking at right here. And this is the peak that they're looking at, because this is a new all-time high in gold price, 2069. So going forward, once it reached the peak and started falling, they retired this Fibonacci. They said, okay, this is our price target at the bottom, and this next one could be a price target in the middle, and this next one could be a high. But once we have that event here, which changes the direction of the gold price and the strength of it, you have to do another Fibonacci to see where we're going forward. So why did it stop at the end of 2020? Well, this is the price peak that we had as a result of the pandemic. Once they started opening up and things started recovering, gold price started to fall. People felt there was less risk, right? So this is the run up of the pandemic, basically starting here, or basically starting here at the 50% mark and going pop, and then it started coming back down. So if you want to know now what gold's going to do in the next 2 years, you have to do a new Fibonacci. In this case, I did an arc. So if we look at this arc, all the arc is you draw from a high to a low. Here's the rock bottom price determined by the previous 3 years from 2016 to 29 or to 2020. So about 3.5 years. And then I took the new big event, which set a new all-time high in gold, and I drew a Fibonacci down to the rock bottom price, where we know it's not going to go below because it's been above that substantially with momentum. And I'll get into momentum in a moment. So we know that this is our new trading range. So where could the price go next? Well, let's look at this, where the price had traded to in this Fibonacci arc. And just to show you this works, the Fibonacci arc is drawn by the computer, and it gives us the mathematical relationships. You can see we have 100% Fibonacci, a 61.8, a 50, a 38.2. These are the most common Fibonacci numbers in the sequence. It's just determined mathematically to be a predictor of many things, not only markets, but like I said, population growth and other heavy data sets can use Fibonacci's. And so what happened was we dropped the Fibonacci lines, and wherever this arc goes and the price touches it, that is either a support or resistance line. In this case, since the price is falling, each Fibonacci line or Fibonacci intersection along this arc with price is going to be resistance, because the market's falling. Risk has been reduced in the eyes of the traders. And so now you're going to look at these Fibonacci lines as resistance lines, where it's not going to punch through until we get to the next bull market. Well, look at what we have here. It tested the Fibonacci line right here in July of 2021, bounced off of it, came back down, tested this Fibonacci line right here, came back down, tested this Fibonacci line, came back down, punched back up through this one, couldn't sustain it, came down, touched that one, came down, and then here you have Russia invading Ukraine. Now, this is a big geopolitical change. Now, all of a sudden, we've switched over to a bull market in gold. So we keep our Fibonacci because we're still in this trading range, and we plot out where we think the price could rise. You can see it goes up to this Fibonacci, bounces off. Goes up to this Fibonacci, hangs above for a while, and then comes back down, bounces off right here, and comes back down, and now bounces into a momentum indicator. So these Fibonacci sequences told us exactly where gold was going to stop. And the only thing that changed that was a major geopolitical event, Russia invading Ukraine. So when you have a major geopolitical event, it will change the direction of this. Okay, this was, or a health event or an economic event. This is COVID, new high. This is Russia, Ukraine, reversed the fall of gold and put it back into a bull market. That's critical. But it bounces off these Fibonacci's till it hits rock bottom, and then it continues to march up. And what's marching up now, these are all the rate increases that the market is pricing in from the Fed. Here's, rate increase here, rate increases here. So they're now looking at Fed guidance for what to do. Why? You had Russia, Ukraine, but the Fed is tightening, and the Fed eventually wins out overall. You had this nice spike because of Russia, Ukraine. Then the news cycle dies down. The Fed starts raising rates, and you have people recognizing, well, gold's probably going to go up. Okay. So now where could the price go? Well, we know it's not going to go back down through the rock bottom price. Okay. This is the key support line probably for the next few years, I would imagine. It could go below this, but it really would have to have a reason to go for gold to go down and break a strong resistance line and punch through all these Fibonacci's and momentum indicators. You have to have just a stunning economy, and the economic fundamentals aren't lining up. So I don't think we're going to go and re-challenge the 1625 bottom gold price. What we have done is we punched through this 50-day moving average. You can see 50-day moving average and a 200-day. So real quickly, this is a different indicator than Fibonacci's. Why am I looking at momentum indicators? Because when you switched from the fall in gold to a rise, and these Fibonacci lines switched from resistance to support on the bottom, where it's now going to go back up. When you switch that in the middle of a Fibonacci sequence, you then start looking at momentum indicators to see how strong that move is. Is it going to punch through the next Fibonacci line, the next psychological trader line? When trader is going to say, I don't know if gold's going to go through there. I think in this case, yes, because it passed through the 50-day moving average and the 200. Now, when it goes through both, you've got a breakout in the gold market. If it goes past 50 and 200-day trading averages, so you look at the gold average over 50 days and 200 days, when it does that, that's a huge psychological factor. It means traders are intentionally punching the price of gold up. They see more risk. So this is an indicator we still have risk in the economy heading into 2023. That would be because the Fed's continuing to raise interest rates. The major banks are coming out and saying we're going to have contractions. The OECD, if we go back here, is going to say we're going to have less GDP or GDP, less accelerating GDP. It's still positive and growing, but it's not accelerating, it's decelerating. And what happens when that happens? Gold price rises. Okay, so we're tying those two together. They're looking at what's going on in the economy and they're saying, less output, 2 trillion less of output next year. That's going to hit the markets. It's going to make it harder to finance debt. It's going to raise interest rates in the economy. We're expecting gold to continue to go up. So the next immediate price level is 1846, 1847. And then I've circled in yellow the next Fibonacci. And if it crosses this Fibonacci, if it continues to go, that's the 1900 gold price. Well, why is 1900 significant? Because 1900 is the previous all-time high in 2011, the last time gold climbed the wall of worry. So this gold climbs the wall of worry, could get up to the 1900 level very easily and potentially go through. If the geopolitical and the economic problems are worse than we expect and the Fed continues to tighten, I think we're going to pop through this level and challenge the 2070 level, 2069, I think is what it got to and change. So I think we'll hit 1900 and then we'll see if we pop through the next Fibonacci. If we pop through the next Fibonacci, I'll give you that number when we go through it. I'll come back and we'll regraph the Fibonacci's and tell you where it's going. But essentially, this has been an exact indicator of where the market's going to go at any point in time. And this is what the traders trade to. And the only thing that changes that are big events, big geopolitical events, where the Fed is raising interest rates, or going back here, where you had the Great Recession and the GDP fell. And those are really good macroeconomic and technical indicators to kind of tell you where you're going to go. All right, next, we got a little bit more to the story. The U.S. stock market has fallen off. And so you can see the exact opposite happens to gold than the stock market. So when you had the pandemic, the stock market fell. I'm just looking at the top 30 equities here in the U.S., just the big boys, if you will. This is a good indicator of what's happened to the big boys. Why does the big boys matter? Because they're the ones most likely to have available extra credit, the biggest sales, ability to take on more debt, to issue more stock, things like that. And when those guys are in trouble, it's a sign that the rest of the market's probably going to be in trouble. So the big sell-off of the pandemic, slow stair-step down to Russia, Ukraine, that's when gold rose. And so when you have the stock market falling due to these either world health events or geopolitical events, gold rises. So I'm basically using that to determine where we could go. If we have declining GDP, and we continue to have, this sell-off in the markets, we'll see what happens in the markets. I think this is going to continue to go up. I think we'll pass 1900 and re-challenge 2069. And then that'll probably come around the end of Q1, maybe Q2, I'm guessing, depending on what the consumer numbers look like for the end of the year. So let's stop sharing for a moment. That's where gold could go based upon the current analysis. Now, what could change? Short of a geopolitical event, short of a major issue in the economy, a bank failure, the Fed making a big change in its policy, a pivot or something, the next thing that we're looking at for the first quarter in 2023, we're looking at sales numbers for the consumer during Q4. Q4 and Black Friday is where a lot of companies go into the black. They make their money for the year on sales, and we're going to see how healthy consumers were. The early numbers out the last few weeks have been that the consumers went out and spent, but they spent on credit, not cash. So they went further into debt. We'll see the effects of that. We could have an immediate boosting in the general market and a little bit of drift down to gold due to rosy holiday numbers. But since it was done on debt, that doesn't make the consumer any more healthy. It makes their situation worse for 2023. So if there is a boost to the general economy and a reduction in gold, it will be transitory or temporary. Okay, use a famous Fed term, transitory. But I think we'll still start to march up in gold. So my anticipation is we hit 1900 and then 2069, and then we reevaluate. And that could come somewhere in the first quarter. But this is just guesstimate. Remember, technical analysis is rearward looking and gives us things to try to predict, but these are not set in stone. So if my calls don't go, we're going to examine why there is a factor why. And remember, technical analysis cannot take into account all the factors that will affect price in the future. Therefore, it's only as good as the information you have in hand. So it gives us a good target and a good model, but doesn't tell us exactly where it's going to land. And that's why you come to Gold Silver Pros. And we're going to continue to analyze that for you. And we're going to tell you during 2023 what's going on. The first place you find that is the weekly market wrap. You can find it on this channel either Sunday night or Monday morning, where we go over the major economic indicators. We give you a really good blowout on what's going on in gold and silver. We tell you the big news stories for the week, and we tell you what you need to do for your trading for the rest of the week, not only in the gold market, but the general markets as well. And that's basically education and research, also not trading information and not a recommendation. I'm not a financial advisor. So that's the first place to go. That's where we'll have their info. And then I'll do these breakout videos about where gold and silver are going throughout the year as we get more information. And I'll use a combination of fundamental and technical analysis to tell you where it's going. All right, that has been it for tonight, guys. Thank you so much for stopping by the program. Remember to support us. We have several affiliates in places that you can go to either get your precious metals or for services that we offer. And for this one, I'm basically going to advertise the Rob Kientz Unfiltered service. If you come to goldsilverpros.com and you sign up as a member on YouTube at the $20 level and supporting the program, you will be able to access Rob Kientz Unfiltered, where I go over a longer term view of what's going on, not only in the economy, but in many other areas of society. And I tell you where I think we're going, where the next thing may happen for the United States. And it goes beyond gold, silver, it goes beyond the economy, it gets into many other factors. So if you're interested in that, certainly go to YouTube and sign up as a member. Thank you, everybody, for joining the program. This has been Rob Kientz, Gold Silver Pros. Until next time.